Okay, we're off. We're running. Midweek update. Welcome. May 4th. May the 4th be with you. If you guys are into that kind of a deal, right? Star Wars, right? May the 4th, whatever. All right, so let's get into a midweek update because we have a Fed meeting. And it's going to be quite the meeting, I think. I don't see how we get out of this without some sort of reaction, and I can't think that it's going to be anything but kind of panic-inducing. We'll see. I'd like to see a reaction, and I'd like to see a capitulation. I don't know if it's going to be caused all at once or it's just going to continue more selling, and eventually we'll get to that capitulation maybe next week. But at the beginning of this month, getting into an aggressive Fed, I don't know what they could do to make things easier on the markets. Let's just jump into it, guys. Real quick, take responsibility for any actions you get from this class. You know the drill, or any others. All right, so we're consolidating. I was thinking that we were going to bounce. I believe Rob and Darren actually made mention of that on Sunday. I think we'd bounce into going into the Fed meeting, and we didn't. There's a lot of weakness out there, very, very weak, and some of those higher flyers are getting punished, and we're seeing a flight to defensive stocks. So we've been seeing it for a little bit, more so this last couple of weeks, and I do think economic data is starting to weigh on these markets. We talk about the war, that's just awful. It's causing its own problems, which will also carry over into economic problems. But on the home front, I'm starting. I do believe that first interest rate hike kind of threw a monkey wrench into real estate. By the way, the worst sector this week. We'll get to it here in a second. And slowed down some loans. And I think at the first bit, the consumer realized, oh, wow, this is happening. Doesn't mean that things are falling apart. We're seeing signs of retraction, right? But not recession. Okay, keep that in mind. We did get our first negative GDP quarter or drop in it, so we'll see if that continues into the next quarter. And then the trade balance, I think, is one that kind of snuck up because China's having another outbreak of COVID, I believe. They're shutting things down. They're slowing their exports. I don't know why. I don't know the specifics. However, that is going to really hurt an overzealous demand that we continue to have. So keep that in mind. Prices are high, but we're still spending money. The expansion's not quite there, so there's a lot of problems that might come to head all at once. We'll see how the markets react to them. On the trade idea front, I chose ExxonMobil. I thought it was great. Any oil company looks pretty decent right now. Any energy company looks okay. It just depends on where you at. KDP, Keurig Dr. Pepper was funny because it's been on the sideways trade. We talked about it, or sideways list for a while. We talked about it going into earnings last week, and guess what? It didn't go anywhere. We'll just take a look at it for fun. On the bearish side, Snapchat, Nike, Goldman, you choose it. If it's a bank, if I'll call it fluff consumer, meaning the discretionary, not defensive. Retail, anything you can think of is just getting smashed. So these are just a few that I liked. Currently, things that you could actually look to trade over the next day or so. Let's start with ExxonMobil. I just love today's candle. I think it's a defensive reach going into this announcement, the Fed announcement here, but it did confirm nicely. It's parked itself up there, so it is confirming a diagonal spread would be great. Straight call, so on and so forth. However, if we get a capitulation week, the win, I should say, but if it's this week that the markets decide to really flush out, I think everything goes down. I think everything does, at least for a little bit. So, it might drop back down to the 85 mark, hopefully not down to 80. So if you wanted to play something sideways and sit through that, I'm totally fine with that. But right, it's in the right sector. It's a good chart. Here's KDP. So I believe its earnings were a few days ago, April-ish. I can see, I'm just looking at the volume, but you can see that it tried to get out of its range and it went right back up. So it's had this 36.50 support for a long time, and it's pretty solid. I'm not sure if there's buyout rumors on it or whatnot, but that stock price is staying pretty tight to that area. So kind of for fun. Not sure if you guys are into those right now. Sideways, that is. Goldman Sachs, I like the gap up this morning and trading lower. So it's trying to revisit that 32 or 320. It touches that. yesterday, I believe. And then it looks like it's just kind of going to give up and go down. So this will be one that will be hurt with the market selling off. Of course, all financials will, especially if the Fed gets a little bit too aggressive, or not too aggressive, but if they get aggressive with the rate hike today, maybe they'll do 50 basis points, and then I think they're doing another 25 right down the road. Or maybe they just do 75 and cause its own problem, but they're ripping the band-aid off. Who knows? Or maybe they'll go 50 and say, okay, we might do 50 later, but further on down the road, we're not going to do an immediate 25. The funny thing is, guys, while I'm on the topic, let's get over to Nike real quick, and then Snap. But there's no winning for them. They're going to be blamed that they didn't do this early enough. They've already been blamed for that, and they're not doing. They're doing it too quickly. They're doing too much or not enough. If we do get into a recession, hopefully it's a short-term one. It's kind of funny to say, but hopefully it's a shorter one. They'll be blamed for that. It's going to be interesting. Blamed for higher gas prices. Blamed for It's funny to see how this happens. So I don't think there's any win for the Fed today. I do like Nike though. It's nice. It's when I took the snapshot, it looks like it was breaking the 120 mark. I don't know if it's bounced since, but I do like that descending triangle pattern it's had since the mid part of April. Looks good. Let's move on to Snap. Snap also kind of a descending triangle. A little anemic bounce back up to that $30 level, and it looks like it's not going to make it. Pushing towards 25, where it had that funny little island gap in the beginning of February. So those are the trades. Those came from our class. A couple I think I poached from either Rob or Corey. But it's kind of the sectors where you find it. And we'll get into that right now after the market performance, because man, you could just throw a dart at anything that's had a pretty decent run, and it's still just getting deflated pretty aggressively. So how are we doing this week? Well, we didn't bounce, but we didn't fall apart. Dow, S&P, and the Qs, they're all flat. They're pretty much in line over the last few days, from Wednesday to Wednesday anyways. So they're not going anywhere. We didn't get the bounce, but we do have that consolidation hesitation. Oil moving higher, obviously, based on the future prices and some of the worries, concern with energy, and then gold actually fell off a little bit as well. I thought that was kind of interesting. So it's a pretty decent sell-off. And if you guys were to take a look, and we'll get to in a minute, the bar chart, the sectors for the week on Finviz are interesting. Interesting. I mean, real estate is just smoked, and then energy is really high, and everything in between isn't doing very well. Here's the SPY, and the expectations were for the bounce. Let me get my pin here. Maybe like a retest of the 430 before this meeting, and you can see we just didn't get it. Kind of a flush out on Monday. Tuesday didn't really follow suit. I thought we would get it in those last few days, but today it's looking a little bit ominous, going into a Fed meeting being down a little bit. I think it's come back since this morning, but the glass is definitely half empty, if you will, moving forward. So let's take a look at the diamonds here. The diamonds, kind of the same idea as consolidating at support levels. The markets behave like this on purpose, especially when they know an announcement's coming up that's of significance. It just depends on how it's digested. So let's go to the Qs. It's also consolidating just below its support levels that is set in March. So we still have the weakest of the threes, the Qs, the strongest of the diamonds, and the S&P is somewhere in between. Doesn't mean that all three of them couldn't just fall once these markets capitulate. I believe they will. And that's kind of the topic I'm going to go for today, folks. As it was mentioned on Sunday's Trading Room, we've been talking about the VIX been popping up, but it isn't capitulating. And Darren summed it up beautifully on Sunday. He said, there's fear out there, but not enough. And he's right, because you don't get a whipsaw effect. You don't get you don't get a sustainable recovery until everybody gives up. You have to give up first before you can recover. So when we have these fringe traders, and I'm not going to say traders anymore, this is institutional money that's still hanging a couple of extra bucks on some of these outliers, right? The idea is, I've pulled out. I'm about 80% defensive. I got 20% still in, Snap or ARC or Peloton or whatever. I pick on those all the time, but I shouldn't. But anyway, some of those outliers thinking that, I'm still not going to go all the way out, because if this bounces, I could be, this genius. Until they are out 100%, like done. I can't afford it. then we can't get a steady build. Taking a look at the economic reports as I blavel, manufacturing, the PMI and the ISM manufacturing numbers are in line. We are seeing a little bit of contraction in economic growth, which is good. It's a slowdown. However, demand isn't. So we're still spending money, but now we are spending money on higher prices and not growing in the jobs, not growing in manufacturing. So you see these numbers here. Job quits 4.5 million. Previously was 4.4. I'm still trying to figure out that number, folks. It's a lot more scary than it looks. But factory orders increased. Core capital goods orders increased. We're still consuming. We're consuming, but we're not growing as fast as we need to keep up with inflation, and it's really causing an interesting little conundrum. So the ADP employment report, once again, contraction expected of 390K, only at 247, and then that trade balance, and that's a big one. Because I say it again, I don't know what's going on in China, but that trade balance is just outrageous when it comes to how much we consume. We need it from other places, which means we're going to pay a premium for that. And don't get me wrong, guys. The conversation or the article that I read saying it's the highest in history. Of course it is. We're consuming the most in history. That's fine, but it does suck to see it go up. We want to be a little bit more of an exporter. Okay, enough of that. FOMC statement we know is coming up. Jobless claims. We'll see where that lies. I don't think any of these numbers are going to make a difference, especially after the Fed makes their decision. Okay, you've heard it a million times. Let's get to what you're thinking about. Let me get my poll. Hopefully I built one for this month. I did. So let's go ahead and launch this. This is funny because we were a -3 on Sunday. We pared that back to a -2 over the last couple of days. And it's sad because you guys can only choose -2. that's as deep as I got, right? That's all we got. So if you hit -2, you can hit it once or twice. I'll know that you really mean it. maybe I'll call it a -3. But the proof's in the pudding. And one of those things, guys, I really wanted to par it back to maybe a -1 or a less aggressive if we did get that move back up to the resistance areas, and we didn't. So this is the first time I haven't seen any sort of optimism, or maybe it was a short cover rally, but we didn't even get that. So people that are short are happy to stay short right now, and no one's really buying anything off the bottom, which means I guess it took everything not to really fall apart before this meeting. I don't see it. So we'll see where it goes. All right, got 94% voted, and you guys voted pretty quickly, and as you can imagine, it's exactly what you thought it would be. We are at 65% -2, 59% -1. We are definitely looking on the bear side, feeling the bear side, hoping for the bear side. I've been working a lot with you guys over the last, I shouldn't say a lot, normal amount, but we've been talking a lot about the bear side as of late, and we've got some really great trades that have come through on the bear side. So great work, everybody. Keep it up. All right, so let's go to, first of all, let me hide this and share with you the shock that is my outlook. No shock at all. So I am going to be, if I can get these to slide, there they go. -2 on the weekly outlook. I wanted to go -3, or -1 actually, but we didn't get that rally. And then on the monthly outlook, I'm at a -2 as well. -3 would be a little bit better, but I think that we're pretty close, or ready for, I should say, a capitulation. I think it's going to come pretty soon. I'm kind of hoping it does, right? What I mean by the capitulation, we need that spike in the VIX, a violent spike in the VIX. Without it, I really don't believe in any sort of move to the upside. And what I mean by that, let me see. I think I can click on this chart and zoom in. First of all, I got to switch. Yeah, nice. Okay, so what I mean by that is if we don't get a capitulation, we're going to get another one of these. That's it. That's all. We're going to get another one of those, this big breath. Okay, that was the bottom. And then guess what, folks? We're going to retest it and fall apart. Without a capitulation, this stays in this trend. We'll just get this nice bounce. Everybody will think it's over. We might even get up to the 460 mark here over the next month or so. then all of a sudden things are realized that we're still raising, the Fed's raising rates. They said 7 times this year. They raise again and again and again and again. All of a sudden you see a carryover. Real estate slows down, falls apart. Jobs do not increase. And you find yourself, well, why the heck did I buy this back up to 460 or $460, right? And then it rolls back down. So that's why I want the capitulation. A chart can't sustain itself, or recovery, I should say, without everybody giving up. All right, enough. See if I can zoom back out without messing up my slides. Oh, well, we're going to go back through here, I guess. Oh, I know how to do this. There we go. Okay. So let's get to the sector analysis. Pretty cool because we got really no movement except for a run to defense and a continuing flight out of what's risky. And that happens to be, it's been tech forever. You guys can see the tech is only down like 0.11% from Wednesday to Wednesday. Still a move to energy. Materials took a break, but everyone's bailing out of real estate specifically. I think financials would be bigger than down just over almost 0.75%. I thought it'd be more than that. But real estate has just been abandoned. And I think that's because, well, what's going to happen here in the next couple hours? Well, a big monkey wrench is going to go into real estate. I think that will also be followed by financials. So the moves are happening. The deflations of the bubbles are happening, so on and so forth. And the flight to safety, I should say, or defensive is also happening. So here's the energy sector. We've touted on this for a while. It looked good last week. It looks good this week. I do think it hesitates at this 80 level till things get cleared up, maybe overseas with a war or all sorts of restrictions when it comes to import-exports of whatever whatever people get their oil from Russia. I think this is going to stay muddled for a while before we can really go clear head. But something sideways to up makes total sense. And then on the bear side, real estate, and you could see the drop off that it had going into last week, and then it followed into Monday. I'm actually kind of surprised that it's holding off here, and I'd expect it to follow a little bit more, but maybe they have priced in the 50 basis points and the expectations of 25 coming soon, which leads me to believe if it's less than that, or if it's more than that, this is probably going to react. So the Fed better stay pretty true to what they said they're going to do, otherwise we might see a little bit more of a reaction in some of those beaten down sectors. So the Fed decision could cause capitulation. I'm kind of hoping it does. It doesn't have to. We always say the markets don't have to correct. The markets don't have to bounce. Capitulation doesn't have to happen. We're just set up in a really good area to where it can. And why that is because the markets are already weak. Trust me, folks, I've seen a lot of correction in bubble bursts. Just when you think it can't go down any further is when it exactly does. So keep that in mind. Or that first bounce where, oh, that was the bottom, which is going to be a big bounce. It's not. It rolls over, and then people just throw in the towel. I don't know what's going on. So I'm hoping it causes it sooner than later so we can have the rest of the year to deal with this. Yeah, let it capitulate. Let it kind of taper out, and then we can build moving forward to the bull side. So the VIX will need to spike before any stable recovery can happen. If we don't see a substantial spike in the VIX, we cannot believe in any sort of rally, whether that lasts a month or even two. Even it just up, it's like, okay, we can buy into it, but I can't go full bore into it. So keep that on that side burner there. We're definitely seeing a bearish defensive move in sentiment. We've been seeing it for a couple of weeks now, and the inflation remains high economic-wise here. Fed remains hawkish and seeing a contraction in growth. Let's stay away from the scary R word, right? Not a recession, but we're seeing contraction, and it's not happening at the same time. If we could see prices come down the same time, production slows down, and the consumer needs to slow down, that's good. We can all slow down at once, and we'll call it, oh, it's kind of scary, but if we're slowing down at once, it's fine. But if inflation remains high, demand remains high, and then we're also receding in some of these factors, that's not good. All right, enough. Let's get to the markets and take a look at some of the trades you're looking at. I'm not sure if you guys have any trades. Oh, we got a couple that came through. The Fed days are tough, and they always fall on Wednesdays. And so every quarter we're going to run into, or every quarter, every few weeks, it's like, oh, geez, Joe, we don't have much to look at. So overall, a pretty good move, though. off the lows, getting back up to even. It looks like the markets will push and pull, especially on a Fed day. So we'll see. All right, Matt. Looks like you got a trade to look at. Mike's got one. But before that, let's get to comments. Oh, yeah, okay, Scott. He said specific support levels on the SPY. Yeah, I think 420 is big. It's significant. The big one I think was going to be the low that we set in March there, right at the end of March. Let me just zoom in a little bit. Well, actually, let me do this. Let's get into a bigger look at it, because if we take a look at it this way, folks, you could see it's pretty significant of an area if we break what we set there in March. And I know it's super recent, but it is technically a pretty bearish or a pretty ominous level, right? It can be, and it could roll pretty quick. So, this could be an overall bull flag pattern. If we can continue this game for a while, which would be a nice, healthy market correction. I don't think it happens. I think it becomes some crazy thing like that, and then it just struggles to find its way back up. So we'll see. So yes, some of the major levels, if you want to look further out, I'll give you my 2 cents on it, is going to be the 420, what it broke, which is going to be big, and the most major is 340. But yes, there's a 380 level here. We could see the 400 mark just below it. We'll call it 400. It would be a pretty good area for it. It's personal. It's your personal outlook in it. I just believe that these markets have a little bit more to give up than the 400 mark. And if you guys really want to pull something fun, let's take a look at the low that we set at COVID problems issues, and go to the high here and snap your Fibos. If you're Fibonacci guys, you'll find it will hit 400. It will hit 380. I think the midpoint on that is, maybe do the math in our head here. Yeah, around 360. So there's plenty of places for this to turn. It just depends on when. And you do need to take into consideration what comes along with it. A good round of earnings season, prices come down, the consumer comes back, stability in the financial markets. It's got to come at the end of the Ukraine war. It's gonna come with 2 or 3 good things, and even then it might be a little bit more muddled, but then we'll get a clear direction. What I love, and thanks for the topic real quick. Let's go back to the daily. What I love more than anything is price action, because opinion is your opinion. And we had a conversation. I'm trying to remember who it was with. Anyways, opinion is opinion, but price action never lies. I can tell you that I'm bearish this or bullish this, but what I do with my money doesn't lie, right? So keep that in mind. If everyone says, "Hey, we're all good, the markets are fine, the war is over, everything's going to turn around," but the prices still go lower, we need to be lower. So support and resistance to end that big old, Scott, I apologize, I went off on a tangent there. To end my tangent, price action. Price action will tell us, watch for those bounces at those levels, but without the price action, I'd stay bearish. Okay. The reason why I'm going so long here, folks, with my blah blah is because we just don't have very many to look at. So let's start up with, I believe, 3 T's. Looks like Matt. Hey, Matt, you playing the Fed announcement. Using the Treasury Pros, 20 years. Okay. Short Treasuries, diagonal call spread, monthly only available. No weekly, short 20. Let's see. Thought this would be a fun one to look at. And it is. It is. Short in the May 20s, maybe the 60, long the June 50 or 55, so on and so forth. Yeah, absolutely. You guys want to play an announcement? It's okay. I'm totally fine with that. The Ultra Pro Share Short. Is this a 20-year bond? Don't they have like a 3-time? You could look for those if you guys want to do something fun. Now I'm just getting irresponsible out there, going to play some of these announcements. That's all right. No, it could be something fun and something interesting to look at. Look what it's been doing over the last few weeks. Yeah, people know it's coming. People know what's going on. At least the markets are preparing for something. DHI. All right, Mike. Targeted put butterfly 70, 72, or excuse me, 70, 62, 50, 55. Okay, fair enough. Nice. You're down here, 60, 70. Okay, waiting for a break. 62, 55. Okay, that's a big one, right? I'm trying to draw those in context. Maybe that'll look a little cleaner there. Or what we could do is take a look at this on a weekly as well. Maybe we can get those numbers. Okay. Yeah, weekly's actually cleaner on this. Let me get my pen back out. All right. 62 and a half. It's pretty much at 70. 62 and a half is right about there, and 55. Okay, sure. Pretty good target right there. I don't mind that. Let's write it down. DHI. Not too many trades. We got one. Thanks, Mike. Well, one so far. Let me get through a couple others. All right, who's next? We got Dan, mRNA. Healthcare's been right in the mix, hasn't it? That thing got beat down for a while, and it's just kind of tapered off. It's funny how quickly the market forgets stuff. Healthcare and Moderna was pretty much the whole world last year, 2 years ago, wasn't it? Now it's almost forgotten. 138, 136, 134. Just looking for a dip back off of moving average toward the recent lows. All right. Got ourselves a butterfly. 138, 136, 134. That's all going to be in here squeezed. Let's see if I can get it down somewhere. 138, 134. Because you're right in the 130 range. So, sure. I like it. These are fun to play. The big movers. And butterflies is a great way to play them. It's targeted. And that thing is tight. You guys would have to zoom in quite a bit to get there. But it's pretty tight. But it doesn't need to get there for very long, does it? Especially if you're going to just take profits once it reaches it. Okay. Oh, Scott's saying, well, maybe I could. If I had my software up and running, I would snap them. Does this snap Fibos? I've never really done these. Never looked in here. Let's see. Oh, I don't think so. These are just oscillators. Yep. Yeah. Well, maybe I could throw something together and send it out a little later. Discard changes. Yeah. Sorry, guys. Usually I'd have my software up, but I shut it down for class, and the reason being is because it bogs it down. Bogs down GoToMeeting like you wouldn't believe. But that would be kind of a fun topic. Yeah. Just go ahead and, yeah. Anyways, what Scott was asking is, hey, Joe, can you snap the Fibos on the SPY and walk us through it? And I said, I'd love to. Maybe we'll do a lab on that. But, yeah, for sure. All right, guys. Sweet, short, to the point. Boy, this is almost like a update more than it was a midweek. Man, I'm sure we'll have a lot more to talk about in the next few hours. So come Sunday's room, we'll probably have a little bit more to go over. But thanks for joining me, guys, and thanks for the suggestions. I think we just kind of hang out here for a little bit. We'll see what the Fed does, and then we'll just circle back. Well, obviously, I'll do the update tomorrow, and then we'll circle back all the way around on Sunday. All right, guys. Thanks so much, and we'll talk to you next time. Bye, everybody.